Metals are starting 2026 with serious momentum, and there are some powerful forces behind the move. Gold, silver, and other metals have continued their strong run, driven by rising demand, tight supply, and growing investor interest. One key tailwind is interest rates. With the Federal Reserve expected to cut rates this year, assets like gold and silver, those that don't pay interest, become more attractive by comparison. At the same time, safe haven demand remains elevated. Ongoing geopolitical tensions involving regions like the Middle East and Eastern Europe are pushing investors toward assets that have historically held up during periods of uncertainty. Add in surging ETF demand with gold and silver funds seeing record inflows last year, and you have steady buying pressure supporting higher prices. But there are risks to watch. Copper prices jumped over 40% last year, and historically, rising copper prices have translated into higher inflation down the road. Trade policy changes and tariff uncertainty could also inject more volatility, while supply constraints, from underinvestment in mining to geopolitical disruptions, raise the risk of sharp price swings. Technically, gold is also approaching a key long-term resistance level versus stocks, which could signal either a breakout or a pause. From our perspective, the overall metals outlook remains constructive. Policy support, geopolitical uncertainty, supply shortages, and strong investor demand continue to provide a favorable backdrop. However, rising metals prices could slow progress on inflation, keeping it elevated longer than expected. Equities remain in a neutral position but supported by solid fundamentals, with a willingness to buy during market pullbacks. In fixed income, positioning stays balanced, with a preference for mortgage-backed securities over corporate bonds, while avoiding excess interest rate risk.